All right. The topic today is our resilient stock market and an endless supply of tacos. And I assume everyone knows what taco means, but in case you don't, it means Trump always chickens out. I did not come up with uh, that title, that word. It's something that was formed early on in the Trump administration, actually during the whole tariff saga, where Trump would, ratchet up the tariffs, scare, talk, very frightening, scary talk, and then sort of ratchet down the tariffs. That's where it all began, and there was a pattern in the Trump administration where a lot of times his bark would be a lot scarier than his bite. And uh, and then many analysts applied it to, again, Wall Street analysts were applying it to his approach in Iran, where personally I thought it was not applicable. And it was not applicable from February 28th until the ceasefire on April 8th. And now, as it comes to Iran, it couldn't be more applicable, right? The bark sounds very fierce, but it is really no longer backed up by any military action. So, anyway, we're going to get into that a little bit later. But let's begin with, well, before we begin with our resilient stock market, I want to make a few other comments, which I think are really quite important. I've spent a lot of time here talking about the dangers that are taking place in our Democratic Party. I've given a lot of warnings, a lot of concern, and of course, with the victory last year of Mamdani in the race for New York mayor, that was the first time sort of a real radical, a severely radical member of the of the Democratic Party took over, took a very important office. And it happened again. Well, it didn't quite happen yet, and hopefully it won't. But a radical, we can call him a communist. He's a communist as well as a radical Islamist. He supports Iran. He supports Hezbollah. He supports Hamas. Uh, Abdul El Sayed won the Democratic Party primary in Michigan. The polls had predicted that he would win, and he did win. So it just sort of shows that Mamdani's victory in New York City, it's not isolated to New York City. This is a trend that is sweeping across the Democratic Party. I think it'll continue to sweep across the Democratic Party. Now, hopefully, Abdul El Sayed will not win the general election in November against Republican candidate Mike Rogers. Um, if he does win, this will, be a really radical member of the Democratic Party taking a Senate seat. And I think, personally, I think this is just the beginning. The Democratic Party has really lost its way. It's becoming more and more radicalized. And unless you are a radical socialist and uphold Islamist ideologies, pro-Hamas ideology, you really don't have much of a chance in the Democratic Party these days. But I just wanted to highlight that. I want to make sure everyone's aware of that. These are dangerous trends that are going to continually be sweeping across the United States. Not in all states, but many states. Any blue state, you have to be very concerned that it's going to go in an increasingly radical direction. Now, this is ultimately, so far, this is not something that investors are going to pay attention to. But if you get enough of these radicals in important positions, this is going to ultimately cause major problems for the U.S. economy and major problems for the U.S. stock market. So when people ask me, what am I worried about? Am I worried about economic data? Am I worried about inflation? Am I worried about the Fed? No, I'm actually not. And I'm going to get into, some of the really positive things that are going on as it relates to the stock market shortly. But this is my major concern. The politics in the United States are becoming more and more extreme. The trends, not only in the Democratic Party, it couldn't be more clear at this point. You know, people who don't see it really have their head in the sand. This is hitting us right in the face. There are also some concerning trends unfolding in the Republican Party. And anyone who spends any time listening to Tucker Carlson, you know, you should have your antennas up. Hopefully, you know, that will come to an end, but it may not, right? I mean, if you look back 10 years ago in the Democratic Party, maybe you didn't love the Democratic Party, but you probably would be surprised to know that communists and Islamists are now basically leading the charge in the party. It's not out of the question that something like this, you know, could happen in the Republican Party. And a guy like Tucker Carlson, he does have great sympathies for socialist ideology, for Islamist ideology. If you've heard of the horseshoe theory, it's when extremes on the left and on the right, they ultimately meet and touch. And you do, we are seeing that. We are certainly seeing that. So it's something that I'm keeping a very close eye on. Uh, but let's move to some positive news now. And that is the state of the U.S. stock market. We've had a lot of wobbles over the summer, but yesterday we went on and made another all-time high. Today it looks like we may be giving some of that back due to some geopolitical factors. But overall, I think the stock market, the U.S. economy is in very good shape. And I wanna, one of the factors that makes me so optimistic about the U.S. economy and the stock market is that this year we've had one shock after another, and the economy has really weathered the storm. The stock market has weathered the storm phenomenally well. So let's go through some of these shocks because it's important to really understand what we've come through. So, number one, obviously, we had a war break out on February 28th. And anytime a war breaks out that involves the United States, that can shock investor confidence. And that's especially so when the war impacts a key resource that the United States is very dependent on, and that's oil. And even though our our access to oil was not cut off in any way, the price of oil, as we all know, went up significantly, and it went up well through $100 a barrel at one point. We're below 100 now, but that was a shock to the U.S. economy, and more than a real shock, it was a psychological shock. And every single oil forecaster that I know was saying that oil would probably go up to close to $200 a barrel. Some even had it going over 200 a barrel. And when businesses and households hear those types of forecasts, the tendency is for them to get very frightened, to pull back on investment and spending, and that can really do damage to the economy. So that was quite a shock that we've come through. And really, the U.S. economy, other than seeing a pickup in inflation, if you look at economic activity, GDP growth, we didn't stumble at all. We've just continued to power right through the war and through higher oil prices. You probably know that the GDP growth in the second quarter came out at 1.5%. That sounds a little sluggish, but it's a little misleading because when you do the mathematics of GDP, import growth subtracts from GDP growth. And when businesses build up inventory, that adds to GDP growth. And then when inventory is drawn down, that subtracts from GDP growth. Okay. But when we are buying a ton of imports, right, that just means that consumer demand is super, super strong. So The fact that GDP growth in the second quarter was pulled down by strong import growth, right? That's a little bit misleading. It suggests that 1.5% GDP growth suggests weakness, but because it was driven by strong import demand means consumers are buying like crazy. So that's actually economic strength. The same thing with inventories. When a business can't sell its products, what happens? Its inventories grow. And oddly, that adds to GDP growth. But when a business can't keep pace with all the demand, its inventories are drawn down, and that subtracts from GDP growth. So, in order to correct for these weird anomalies, there's a concept when we do GDP accounting, there's a concept called final sales. And that's really what we want to focus on. So, final sales is all the goods and services that the United States produced. How much were sold in that quarter? That's final sales. And if you look at final sales, it was actually a booming quarter. Final sales showed that the economy grew by 3.9% in the second quarter. So that's very, very fast growth. Now, in addition to this, the early data that we have for the third quarter, and it's early, and I don't expect this pace of growth to continue. But the early numbers show that the U.S. economy is expanding right now at a 6% rate. Okay, that again, I think that's too fast. I don't think it'll sustain there. But it just shows you that this economy, from a growth standpoint, is actually very robust. So no concerns from a growth standpoint. So the point here is we've went through a war, very high oil prices, and we've weathered that storm very well. Uh, next point, next shock that we've suffered is these higher bond yields, right? Bond yields, when Trump first came to office, they were about 4%. Okay. Last week, they crossed 4.7%. So that's a 0.7% rise or a 70 basis point increase. That's quite a big rise in bond yields. And of course, that filters through the entire economy. That means mortgage rates have gone up by 70 basis points. That means all sorts of lending rates, businesses and households, when they need to borrow, they're now paying 70 basis points more than they did it, early on in the Trump administration. So this is a major shock, uh, and the reason why bond yields have gone up so much is A, because of the higher oil prices, and B, when oil prices go up, obviously inflationary pressures rise, and bond yields go up as inflation pressures increase. So, uh, again, the U.S. economy has weathered that storm well, as I just discussed as we went through the GDP numbers. Third, um, the tariff shock that we had in 2025, it didn't end. Why didn't it end? Because, well, we had the Supreme Court strike down the Trump tariffs, and after that, a couple weeks ago, the Trump administration started to come up with plans for imposing new tariffs, and they did. They've slapped on a whole bunch of new tariffs to replace the tariffs that came off, and that creates a lot of uncertainty for businesses, right? Constantly trying to figure out, okay, what are the new tariff rates that we're going to have to pay? And many economists worried that this uncertainty would hit the economy, hit business investment, but it hasn't, right? So that's another shock that this economy has just shaken off. Uh, Fourth shock, and I think this one is very considerable, very important. I think that the war got off on February 28th to a really good start, and up until April, we were pounding Iran, and actually the stock market, as you would expect, would stumble a bit, but it managed the storm pretty well. Because when markets do reasonably well, when there's a lot of certainty. And if we know that, for the next 4 months, we're going to be slogging it out in a tough war, that's something investors can handle. But what gets much more difficult is uncertainty. And I would characterize this war as being very, very mismanaged. 1 minute Trump is going to cut their heads off, and the next minute these are reasonable people, and we can make a deal with them. And you know, it changes sometimes from week to week, sometimes from day to day, and sometimes from hour to hour. And that type of stop and go, that type of uncertainty can really have profound psychological impact and hurt business investment, hurt consumer behavior, but it hasn't. Right. And I think to some extent it's because the American public maybe has just you know, tuned it out. They're not listening anymore. And businesses as well. So they're just operating as businesses as usual. They're ignoring all the Truth Social posts, and they're just moving forward as if it's business as usual. So from an economic standpoint, good. That's healthy. Better that it not interrupt the state of our economy. So that's another shock, weathering it just fine. Then moving to some economic shocks, we had this nosedive in technology stocks, AI stocks, and semiconductor stocks, right? They really took a sharp nosedive in July. And it didn't just start in July. We've been living with these concerns. How many times over the last year and a half have you had big famous investors come out saying this is a bubble? There's too much investment in AI. The return on investment is going to be incredibly disappointing. And this really could have rattled investor confidence. It could have rattled business confidence who are investing in AI, right? They could have pulled back. But the investment keeps flowing. Business confidence hasn't been rattled. This July sharp decline in some of the highest flying stocks, AI stocks, tech stocks, really has not done much damage to investor confidence, and we continue to chug along. And it was really impressive that yesterday, we went on to set another new market high by a long shot, right? In our global macro update, I made the point that 7,600 on the S&P 500 is a key level, and we blew right through 7,600, and then we charged through 7,700. So these are pretty key levels that we push through. Now, we have the fifth shock. We have a new leader at the Fed, right? A new chairman of the Federal Reserve, and he has a completely different approach than any Fed chair that we've seen in modern times, right? We've had Ben Bernanke, we had Janet Yellen, we had Jay Powell, and now Kevin Warsh is a major break. Now, why is he so different? Why is he so different? Prior Fed chairs were incredibly transparent. They would give us a crystal clear picture of how they saw the economy. Was employment strong? Was the economy in good shape or poor shape? Were they concerned about inflationary pressures building, or did they think inflation was subsiding, right? And prior Fed chairs would talk in great depth of the way they saw the economy, and that would give us very important clues as to what the Fed was going to do with interest rates in the future. Warsh has a very different approach. He thinks that the Fed should not be holding the hand of investors, and the Fed should essentially keep its mouth shut. And he's had a couple press conferences now, and in those press conferences, he's virtually shared zero views, right? He's told us nothing about the way he sees inflation, about the way he sees the economy. Zero. The only thing he's told us is he's going to bring inflation to 2%, that he's not going to be flexible on that. and he blames the prior Fed. Implicitly, he's blaming Jay Powell for inflation running above 2%. And he says, I'm not going to tolerate that. That's the only information that he really gives us. I know I saw in some of the comments in the options premium chat, some people, the market was going up as Warsh spoke. And the reason why the market was going up as Warsh was speaking is because investors thought he might say we need to raise interest rates. And the fact that he didn't say we might need to raise interest rates, initially the markets cheered. But as he kept talking, markets figured out, you know what? This guy's not telling us anything. He's giving us absolutely no information whatsoever. And by the end of his talk, the market crashed, right? Because Kevin Warsh is completely ambiguous, at least so far. He gives us no information, right? And this is a very big dose of uncertainty that investors have not had to deal with since the 1990s when Alan Greenspan was Fed chair. Alan Greenspan also was famous for giving very limited information. But his reason for giving very limited information was very different from Kevin Warsh's reason. So I'm going off a little bit on a tangent. Alan Greenspan was known as one of, if not the best Fed chairs in American history. The reason why Greenspan, and this is by Greenspan's own admission after he retired from the Fed, the reason why he didn't give much information to markets back then is because in those days, the Fed didn't really know if raising interest rates or cutting interest rates would have much of an effect on inflation. Right? It was like an experimental period. The Fed was, learning a lot and finding its footing. Okay. And he didn't want to give investors too much information because he wasn't very confident of his views. So he didn't want to give investors information and seem like he was confident that the Fed should raise interest rates when in fact the next day he might change his mind. So today, the Fed knows a lot more about conducting monetary policy. It knows a lot more about the impact of raising rates and cutting rates on the economy and on inflation. So over time, Fed chairs became more and more transparent because they became more confident, for good reason, that their instruments, that their tools for bringing inflation down or causing the economy to accelerate, they're more and more confident that their instrument, which is essentially interest rates, works. Okay, so why is Warsh being so ambiguous? Okay, why is Warsh being so cloudy and non-transparent? Well, he thinks that too much hand-holding causes excesses in the market. He thinks it gives investors too much confidence. And if investors are so certain of what the Fed is going to do, they will take on more risk than they should. Okay. So that seems to be his reason. And it's not a bad reason. So there are really two camps. After Warsh's press conference last Wednesday, we have the emergence of two camps of economists of the way they view Kevin Warsh. And by the way, this all ties in, by the way, to all the shocks that the US economy is facing. And the Warsh shock is very real. Okay. But before we really understand the Warsh shock completely, I want to give you a little description of these two camps and how they view Kevin Warsh. The first camp says Kevin Warsh is injecting unnecessary volatility into the financial markets with his lack of communication. And you can see it, right? You can see it very clearly. Bond yields since Kevin Warsh took over have gone up. For sure they have, right? And that's some of the uncertainty getting priced in. The stock market hasn't done well either, right? The stock market really struggled. And very specifically, It had its worst single day of the year on Wednesday after he spoke because he said nothing and created all this uncertainty. So one camp says, you know what, it's dangerous for there's enough uncertainty in the world, right? We don't need even more uncertainty from our Fed chair, the most powerful economic policymaker in the entire world is now going to add all this uncertainty. We don't need this. We live in an uncertain world. We don't need even more uncertainty by the most powerful economic policymaker in the world. Okay, so that's one camp. The second camp says that, you know what? You guys don't get it. Wall Street is throwing a temper tantrum because it isn't used to such little guidance from the Fed. Okay. But we need to return to the old days. We need to return to the days of Alan Greenspan. Um, and we you know what, we don't need we shouldn't have to rely on the Fed to hold our hands and tell us exactly where the economy is and whether we need to cut interest rates or raise interest rates. You know what, Wall Street can figure that out by themselves. Grow up, be adults. So that's the other camp. Okay, so you see these two extremes. Just to give you an example, there's an economist that I used to think was quite good at Bank of America. His name is Mark Cabana. And he wrote an article, and he fits firmly into the first camp. And he said the sell-off in government bonds, that rise in yields that we saw, he said, was a textbook lack of credibility shock. Meaning, Warsh comes out, he doesn't tell us anything. And the reason why bond yields rose is because the market said, oh boy, this guy isn't serious about fighting inflation. He said, I'm going to bring inflation down to 2%, but he gave no indication that he's going to do that. And he's probably going to just bow down to Trump, who wants him to keep interest rates low or cut interest rates even lower. And that's why bond yields went up. The market is worried about inflation getting out of control. And inflation right now, excuse me, the 30-year bond yield, the yield on the 30-year bond reached its highest point since 2007 last week. Okay, they've come down a little bit this week, but because oil prices came down. But last week they hit the highest point since before the great financial crisis. Okay. And according to Mark Cabana from Bank of America, that's because Warsh is blowing it on the credibility side. He's not being seen as an inflation fighter, and that's very dangerous. Okay. Now, I singled out Mark Cabana just because he's a guy I have a lot of respect for, but there's many, many others who hold the same view. Now, the Wall Street Journal, on the other hand, had an opinion piece, not an opinion piece last week, written by the editors of the Wall Street Journal, and they made the case that, come on, Wall Street, grow up. You're just a bunch of babies. Okay. Yeah, it's going to be a more uncertain world now, but you need to be adults. So those are the two views. But needless to say, the point is, this is a new world with a new Fed chair, and he's operating very, very differently. Now, I'm going to give you my view, okay? My view is a bit different than either of those two camps, okay? I could see it either way, right? I think both sides have a point. But what concerned me about Warsh's press conference is that it's not so much that he didn't say anything, and he didn't say anything. It's more that he said some things that made no sense. And it made me question his competence. So I want to give you an example of that. He took complete credit for rising bond yields. Now, Mark Cabana said rising bond yields is a big problem because it's a result of investors thinking that this guy's not serious about fighting inflation. Okay. Warsh said the reason why bond yields rose is because they see how hawkish I am, how tough I am. And the market adjusted to my tough language. And that's why bond yields rose. But what Warsh completely neglected in a shocking way, is that oil prices went up about $20 from his last press conference, from his first press conference. And why had they gone up by $20? Because the United States had been striking targets by the Strait of Hormuz. Iran started striking ships traveling through the Strait of Hormuz. So the United States responded, right? So oil shipments through the Strait of Hormuz were being reduced, and that put upward pressure on oil prices. And upward pressure on oil prices means higher inflation expectations, which puts upward pressure on bond yields. So Warsh is taking all the credit for the higher bond yields, saying it's due to me, right? But it wasn't. Maybe some of it was due to him. Mark Cabana thinks it was all due to him, and his lack of inflation fighting rhetoric. But a lot of it also had to do with the global economic environment, higher oil prices. And if he can't recognize that, you know, that's a problem. Now he must know it, but not to speak about it. It's deceitful. You do not want your Fed chair to be deceitful. Okay, maybe he doesn't have to say everything that's on his mind, but to actually be misleading is problematic. It definitely damages the credibility of the Fed. The other point that he said, which I found very problematic, he said that I don't want to hold the hands. He said it in other words, using other words, but I'm paraphrasing. I don't want to hold the hands of investors and tell them exactly what I'm thinking because I want market prices to provide investors with information. I don't want investors to look to me for the information. I want investors to look to the market and get information from the market. So if bond yields are rising, that provides information to the market. If the stock market is falling, that provides market information to investors. And he said, I want investors to respond to market prices, not to my words. Okay, that's fine. That's a completely fair analysis. But then he was asked the following question. Well, bond yields are rising. Higher bond yields are typically seen as a signal that the Fed should be raising interest rates, right? If bond yields are going up, it means the Fed should pay attention, and that's a market signal, an important market signal that the Fed should be following that and raising interest rates themselves. Okay. Now, Warsh, based on what he said, that the market provides incredibly valuable signals, I want investors to pay attention to those market signals, right? That's what he said. But when he was asked the question, doesn't it mean the Fed should raise interest rates? Isn't that the signal the market is sending you? He said, well, sometimes market signals can be wrong. So he completely contradicted himself. So again, this raises the question about competence. Now, I don't think Kevin Warsh is incompetent. I don't. I think he is trying to be so murky and misleading with his statements that he's getting himself into trouble. And that ultimately that's going to be a problem. Now, again, the markets handled, yes, last Wednesday, the markets took a beating. And some of that beating certainly had to do with, I think, one of the worst press conferences that I've ever seen. I shouldn't say one of the worst press conference by a Fed chair that I've ever seen. And by the way, it's the first time I'm saying it. I wanted to make sure that like I wasn't like missing things, and I've read numerous analyses of by very good people on the press conference, and I can confidently say that I'm not alone thinking that it was the worst press conference by a Fed chair, probably at least since before Greenspan. So that's a major shock, and the financial markets have handled it incredibly well. So rather than being shaken by Warsh, and ultimately if Warsh doesn't learn and improve on the job, and I think he will improve on the job, uh, um, but I'm encouraged by it, right? I'm encouraged that the market is so resilient that it could handle such a poor performance. Okay. So where are we with the market? The S&P 500 closed last Friday at 7489, 7,489. Okay, that's the level that it closed. It had made an all-time high way back on June 2nd of 7609. So from between June 2nd and last Friday, it fell. It was at 7609. It fell to 7489. That's not a dramatic fall, right? It's, I didn't do the math. It's, around 3% or so. Um, but essentially, all summer long, it's been stuck in this range and essentially averaging about 7,500, right? All summer long, just kind of stalling out, just kind of flatlining. Uh, but but beneath the surface, okay, beneath the surface. And we know this because our portfolio, it wasn't down just 3%. We were down more because we're very heavy in tech and semiconductors. So below the surface, there was a lot of turbulence with tech, AI, and semiconductors getting pummeled, right? Getting pummeled. So last week's volatility, right? That Wednesday, large Wednesday sell-off, it actually forced the liquidation of this guy, this young guy, Leopoldo Aschenbrenner. He has this hedge fund called Situation Awareness. His hedge fund, because of that volatility, it got hit with margin calls, and he essentially had to liquidate most of his holdings. And he was clearly young Leo, or Leo, we should say. I had a friend Leo, but this guy's Leopold. He was unaware of the risks that his leveraged bets were presenting to him. Right? He really did not have a good grasp of leverage. He's a young kid. I'm sure he's an absolute genius. Has incredible investment ideas, but he doesn't know the first thing about risk management and leverage. And when you're levered up, when you've borrowed to build up big positions, you don't need such massive moves to wipe you out. And that's exactly what happened. Although we did have pretty large moves, so we had big moves on his tech and semiconductor exposure, AI exposure, and he just got wiped out. Now, we weathered that storm, right? We weathered that storm. Oftentimes, when you see such a massive move and you get a hedge fund like that getting wiped out, there's a lot of other hedge funds that get wiped out also, and that can bring down the entire market. But it didn't, right? It actually this sell off and the Leo getting wiped out represented a huge buying opportunity. And we saw Citadel, the hedge fund, step up and snap up all of Leo's holdings, right? And they bought it at low prices. Um, By the way, if you're interested in which, just a little anecdotal information, the companies that had lent money to Leopold, and they did margin calls on him, Goldman Sachs, J.P. Morgan, and Bank of America. Those were the ones. And they didn't do anything wrong, right? He had losses. They called in margin. They forced him to sell. He became a forced seller. Citadel steps in. They see bargain prices. They snatch it up, and effectively, that represented the bottom of the market. And now we see that the dust has settled. The S&P 500 information technology sector, okay, which everyone says is in bubble territory, bubble, bubble, bubble. It's trading at a 12-month forward PE ratio of 20. Okay, that is not expensive for the technology sector. I would even say it's cheap. The overall S&P 500 PE ratio is 19.4, so it's barely above the overall S&P 500. Um, Now, semiconductors, which is the sector that got hit hardest, right? And SOXX, SOXX is a semiconductor ETF. That got walloped. But now, after the walloping, a combination of that decline in the market, the sell-off, combined with just booming earnings that these semiconductor companies are reporting, the PE ratio on the semiconductor sector is 15.9. Okay, that is cheap. Okay, so anyone who says that semiconductors are expensive and there's a bubble, it's one of the cheapest sectors in the market right now, 15.9. So it's a bargain. Um, Now, again, I mentioned that, the S&P 500 closed at all-time highs yesterday. And I've been suggesting that the fundamentals of the stock market are very strong. And I went through five major shocks that the stock market and the economy have confronted recently. And the market has handled it incredibly, incredibly well. And that suggests that the market is very, very resilient. But now I want to just enumerate, um, you know, eight or nine uh, items that really suggest that this market is really in very healthy shape. First, um, every sector, or nearly every sector, 10 out of 11 sectors in the S&P 500 have reported earnings beats, right? Their earnings reports have exceeded already optimistic Wall Street expectations. Okay, that's tremendous, right? 10 out of 11 sectors beating optimistic analyst expectations. Second, so these are all, I'm listing you reasons for why other reasons beside the resilience that we just went over, other reasons why I'm very optimistic about the stock market. We have seen over the month of July a major rotation, right? People were rotating out of technology and AI and semiconductors and going into old economy stocks. Now we've heard, for actually, 2, 3 years, that if the leadership in tech, if tech got hit and rolled over, because this was such a narrow stock market rally, if tech rolled over, it would pull the entire market down and we'd be looking at a massive 40, 50% market decline. Okay. Now, tech took it on the chin. It fell hard. But guess what happened? The old economy stocks took over the leadership. And now this rally is anything but narrow. If anyone tells you that we have a narrow stock market rally, they don't know what they're talking about. This rally or the fact that the stock market only declined by 3%, the S&P only declined, it's because so much of the market did very well. If you look at financials, banks, industrials, consumer staples, all these sectors did, healthcare, they did very, very, very well. And that's why you could have certain stocks tech stocks declining by 40% in July, and the stock market only declined by 3%. Okay. So we have a rotation. The stock market now is a broad rally. Okay. So now so defensive stocks are rallying now with cyclical stocks. Defensive means when the economy is, going down the tubes, those stocks tend to do well or outperform. Cyclical stocks tend to do well when the economy is doing well, right? But you have defensive stocks and cyclical stocks both doing well at the same time. Very positive. Value stocks are stocks that tend to be cheap and inexpensive, right? And usually, when people are buying value stocks, they're selling their growth stocks. We saw that in July. But starting this month in August, growth is rallying. Growth stocks, growth means tech, by the way. Growth is just another word for tech. Growth stocks, tech stocks are rallying together with value. They're both booming. Uh, Large cap stocks and small cap stocks. Usually they both don't do well at the same time. Right now, large cap is rallying and small cap stocks are rallying. Okay. So we have one of the broad, at least so far in this month, this is one of the broadest rallies that we've ever seen. Okay. So much for this argument that this is the narrowest rally in history. That's over. That argument no one should be making anymore. Another important point, a lot of times companies will play games with their earnings. So, they may report pretty good earnings, but the revenues don't look so good. So what's the difference between earnings and revenues? Earnings, with revenues, you're just looking at sales. You're ignoring all the costs associated with running a business and selling a product, right? So that's revenues. A lot of times companies will play games and inflate their earnings by playing accounting tricks, but you cannot play accounting tricks with revenues. It's impossible. But right now, revenue beats are just as impressive as earning beats. So we know that the strong earnings, there's no gimmicks being played right now because revenue beats are just as impressive as earnings beats. So this earnings season is super solid. The earnings reports and revenues reports are so impressive that already you have Wall Street analysts raising their expectations for next quarter. That's highly unusual, right? And they're doing it because they're listening to the earnings calls, right? That the businesses that the corporate America is holding. They report earnings, and then later that day they hold earnings calls. They're so impressed with the earnings calls that they're already increasing their expectations for earnings for next quarter. Very positive. And then the final thing I'll say is that the international stocks also seem to have turned the corner, and that's good, right? You don't necessarily. It's true that all of our, I'm a big believer in U.S. outperformance, and it doesn't make a lot of sense to be very heavily invested outside of the United States. But the truth is, it's not terribly healthy when it's only the United States stock market that's doing well. It's good to have some international support, and we do. So international stocks are also doing reasonably well. So these are all, very positive reasons to be optimistic. Also, I'm encouraged that Bitcoin is not really participating in this rally. Because when you have Bitcoin, hitting 100 and 110 and 150, that to me speaks of a lot of excess in the market. When Bitcoin is just sort of trading sideways, between 60 and 65 or whatever, there's not a lot of froth. There's not a lot of excess. People aren't doing incredibly stupid things. So that gives me some comfort. And again, Leopold getting crushed. I feel badly for him. He'll be okay. He's a young guy. He's smart. I'm sure he's still very wealthy, even though his hedge fund got creamed. Uh, the fact that, a lot of fraud, but he represents froth, like way too much leverage. He wasn't the only one who got taken out. A lot of hedge funds that didn't grab the spotlight also got taken out because they were running too much leverage. So cleaning out this froth, is very, very good. And the way I've heard, someone characterize it, and I would agree with this characterization, the bull market didn't die in in July. It got reset, right? We had some cleansing. The market handled it very well, and now we're probably poised, to continue to chug along and move higher. Um, Now, the main obstacle in my mind, to a to the bull market. And actually, from a market standpoint, it doesn't bother me, because always one of my biggest concerns is, because this economy is in such good shape, because AI is so revolutionary and transformative, the risk is we do end up with a bubble. So, from a purely market standpoint, these headwinds coming from, geopolitics and Trump's mismanagement of the war, from a pure market standpoint, forget about what it means for, the United States leadership in the world, and destroying a terrible actor in the world, a terrorist state, dealing a good blow to China. All those things would be very favorable, but it would might also lead to a bubble in the stock market, right? If things are too good, you end up with bubbles. So from a purely market standpoint, the mess in geopolitics is preventing a stock market bubble. So that's an optimistic way of seeing it. But let's now move to geopolitics. I don't want to spend a tremendous amount of time on geopolitics, but let's hit it. So this morning, we learned that the Trump administration just removed sanctions on three entities linked to the Iranian IRGC. Okay. So that shows you, like, a deal has not been signed, and Trump is so desperate to show goodwill to the Iranians, even though we haven't signed the document yet. I want to show you how much I want to end this war. I'm going to remove sanctions on you. Okay, so that's already taken place, and it was posted on the U.S. Treasury's website, right? That's Scott Bessent, the Treasury Secretary. They posted it on the website that we have removed sanctions on three entities linked to the IRGC. Pretty crazy, but that tells you a lot. Um, so we heard that a deal first was going to be signed on Tuesday. That was yesterday. Then a deal was going to be signed today. And who knows, it still might. But the last thing I read before jumping on this call was that it's now been pushed to Friday. So this is the Iranian game, right? Extend and extend and extend, lengthen out the negotiations, play the United States, right? The Iranians are the best negotiators in the world, and we are probably the worst negotiators in the world. We're incredibly naive. And it looks like they're just pushing it out, stringing us along, as Trump likes to say, tapping us along. So that seems to be what's going on. Now, what is going on? What is going on? And I am going to deviate for a couple minutes from Iran to give you some insight into another part of the Middle East, to shed some light on what I think is going on here, at least to some extent. Um, the United States under Trump has been pressuring Israel to strike a peace deal with Hamas. Okay. And a couple months back, the Trump administration announced what he called a 20-point plan. The 20-point plan was essentially, to summarize, Hamas would disarm, right? They'd give up all their arms. Gaza would be completely demilitarized. That is, all the weapons would be removed out of Gaza. So it would essentially be a harmless territory. And then after that was done, the IDF, the Israeli Defense Forces, the military, would pull back to the perimeter of Gaza. Okay. The 20-point plan was just a lot of details, but that was the bottom line. A demilitarization of Gaza, right? Hamas would essentially give up all their weapons and Israel would pull back to the perimeter. Okay. Israel said, okay. Now, not for a second did Israel think that this would come to fruition, but they said, okay. So now there is a new version of this 20-point plan. It's being called the 15-point plan. And essentially what it is, the Trump administration is attempting to cram down on Israel another arrangement. And this is the other arrangement, right? I'm going to summarize it. Hamas is required to turn over its weapons to another group of Palestinians inside of Gaza. Okay. These weapons will be stored inside of Gaza, but supposedly out of the reach of Hamas. Okay. But prior to that taking place, Israel must withdraw to the perimeter of Gaza. Okay. So there's no demilitarization of Gaza. The weapons remain within Gaza, but officially out of Hamas' hands. But the reality is, we know the people who will now possess the weapons. And who are they? They're people who used to be in Hamas. They're people who have aided Hamas. So they're essentially Hamas's best friends. So Hamas is going to give the weapons over to all the people that may not officially be in Hamas, but they comply with Hamas, they cooperate with Hamas. So in reality, Hamas is just transferring weapons to itself to be handed over back to Hamas at some future date. So let's be real. What this new Trump plan is to restore Gaza to what it looked like before October 7th of 2023. That is, Israel withdraws and Hamas is back in control. Okay. Now let's be clear. The probability that Israel agrees to these terms is zero. Okay. It's not happening. But where in the world is this coming from? And I'm shedding light on what is actually going on with Iran, right? The way to understand Iran is to understand what's going on here. So Hamas is not surrendering, right? Hamas, it's just a game. It's a disguise. Who's calling the shots? Who's giving the Trump administration? And who are the negotiators? The negotiators here are the same people who are the negotiators on Iran. It's Stephen Witkoff and Jared Kushner. They are negotiating. Who are they listening to? And who is Trump listening to? Well, it's Turkey, Qatar, and Egypt. Most importantly, Turkey and Qatar. They're the ones who came up with this plan. And they are the ones that will enforce the plan together with Egypt. So who are Turkey and Qatar? They are two countries that have Muslim Brotherhood ideology. They're run by the Muslim Brotherhood, which is no less extreme, no less radical than the Iranian regime. It just is they're not Shia Muslims, they're Sunni Muslims. And they are U.S. enemies just as much as they are Iran's enemies. They are determined to undermine the United States' interests in the Middle East. That's their objective. And they are encouraging the Trump administration to cram down this arrangement on Israel that would put Israel's security in grave jeopardy. But for whatever reason, it's a reason I don't understand, and I don't think anybody understands it. For some reason, Turkey and Qatar have enormous influence over Trump. It's funny, right? People say that Israel has influence over Trump. Israel has no influence over Trump, or very little. Turkey and Qatar have enormous influence over Trump. Now, I can understand why Qatar has influence over Jared Kushner and Steve Witkoff. right? We can understand that because both of those men have enormous, enormous business interests in those countries. Enormous. In fact, a lot of Jared Kushner's money raising from for his, I'd say 98% of his fundraising for his private equity fund that he runs comes from Qatar and Saudi Arabia. So I understand why Jared Kushner, like, is his mind is completely warped and he can't be objective in this process. You know, Trump is maybe a little bit trickier, but he has enormous respect for, especially, he praises Erdogan, uh, you know, endlessly. And their goal is to return Gaza to pre-October 7th, 2023, meaning Hamas has total control. And this is a great way of not only, trying to destroy Israel, but undermining the United States as well. Turkey is essentially now, together with Qatar, managing the Gaza portfolio. Trump has handed it over to Turkey. Turkey is also trying to push Trump to force Israel to make all sorts of concessions against Hezbollah in Lebanon. Okay, so these are very, very dangerous things. Now, why did Trump step back from bombing Iran, right? In Trump's words, and of course, I don't believe him, but he said this was going to be the biggest bombing campaign that the world has ever seen since the US bombing campaign in World War II. And why did he call it off? He said he called it off because of countries in the Middle East. So who are the countries in the Middle East that called Trump and told them to stop? Well, we know it's Saudi Arabia, we know it's Turkey, and we know it's Qatar. Those are the three. Trump is listening to these guys, just like he's listening to them in Gaza, like he's listening to them in Lebanon. He's listening to them when it comes to Iran. For whatever reason, Trump loves President Erdogan in Turkey, who's Muslim Brotherhood, and he loves Qatar, who's Muslim Brotherhood. He somehow doesn't understand that these two countries are far more aligned with China than they are with the United States. And what do they have in common with China? They want to undermine the United States. They want to weaken the United States. And Turkey and Qatar are playing both sides. They're they are I wouldn't even say they're playing both sides. They're basically pretending to be a US ally, but in reality, they're a close ally of China and Iran. And they are no doubt representing Iran's interests, but in a very manipulative, sneaky way. So that's where we are. Now, we hear in the media almost every day now, and this is, by the way, this is not new. We've been, if you really have your, ear to the ground and are really paying attention, we started to hear about weapons shortages, defensive weapon shortages, offensive weapon shortages way back. I mean, way, way back. I was hearing it in March, certainly in April. Now it's in the media every single day. It's being leaked and leaked and leaked. As I've said, I don't really believe it. I think there's some truth to the weapon shortages, meaning, and I've done a lot of research. There was an extensive essay written on this in the Free Press last week. We certainly have enough weapons to deal with Iran. We 100% have enough weapons, offensive and defensive, to deal with Iran. The problem is, if we got into a war tomorrow with China and Russia, then we have a problem. Okay. But that's not new. That's not new. We would have had a problem with China and Russia before the war started. Because if you're making the case that we can't fight a war that lasted 5 to 6 weeks, because that's really all this war lasted, right? We've essentially been doing very, very little since April 8th. If we couldn't fight a war that lasted 5 to 6 weeks against a very mediocre power, which is Iran, how in the world would we fight a year, a multi-year war against China? If we were out of equipment After 6 weeks of war with Iran, we were out of equipment before the war with Iran even started. Okay, let's be serious. Let's use our logic, right? We would exhaust military resources at a far more dramatic pace against China and Russia, especially if we're fighting the two together, than a war against Iran, where we were fighting together with Israel, right? I mean, it just makes no sense. The people who are leaking this want to stop this war. They're trying to put massive pressure on the Trump administration to just walk away. That's the reality. That is what is really going on here. A massive pressure campaign on the Trump administration to make the US popular. That's why it's in the press every single day, right? You don't leak these things if you don't think that it's going to if you don't think it's going to have an impact on the Trump administration, right? They're trying to make Trump more and more desperate, to make this war, less and less popular, to make Trump think that, the Americans are panicked, right? This is very intentional. It's being leaked by very high up people, right, within the Trump administration. By the way, Trump said another reason why he didn't strike. He mentioned Saudi Arabia, and our Arab allies as one reason. They asked him not to strike. That was one reason. He also mentioned that there were very dangerous leaks from the United States to Iran that let them know the precise timing of our attack. Now, he just said timing, but perhaps it was more than timing. Perhaps it was also targets. To have that type of information, and Trump said it was a leak, and he said these people are criminals, they need to be put to jail. This has to be coming from a very small circle inside the Trump White House. And they're undermining the Trump administration. That's what this is about. They're trying to stop this war because they hate this war. They're isolationists. They want the United States to pull back. So that's where we are in geopolitics. One day on, one day off. And if there's something that's going to damage market psychology, it's this. Because it makes the White House, it makes the Trump administration look incredibly inept and weak. So are we going to overcome this? I don't know. At one point, I was very confident that we would. But every single day that Trump makes a big, bold threat, I know ahead of time it's nonsense, right? Now I already know. The shock would be if he actually carried through, right? The shock would be if he actually carried through. But if he really meant business, right? If he really meant business, he would keep his mouth shut and just bomb, right? Anytime you make a threat, you're preparing your enemy. And if you really want to have massive impact, it should be a surprise attack. How did this war start? It started on February 28th. No one said a word. Trump didn't say a word. We just went for a massive, massive strike. That's the way you fight a war. That's the way you begin a war, right? With a massive, massive strike without any advertising ahead of time. So every time Trump makes a threat, I think it's just a negotiating tactic to try to frighten the Iranians. But the Iranians now, they have no fear. They have zero fear, right? And that's why, if there is some agreement signed, you can be sure that Iran is going to be back attacking international shipping. They will. And if there is an agreement, by the way, we didn't cover this. I mentioned it in our global macro note. The agreement is going to be very favorable to Iran and essentially going to be a U.S. surrender. But even that, the Iranians will break that agreement because their objective is to destroy the Trump presidency, to humiliate him, to make sure that the Democrats come to power and win the 2028 election, and then they'll really have it free, right? A real free ride. So that's their objective, to continue to humiliate Trump. They no longer fear him. They don't take a strike very seriously. They believe all these stories that the United States is out of weapons, right? So if this is benefiting anyone, it's benefiting the Iranians. It gives them more courage. It makes them think that we're a paper tiger. So this is very distressing. The market is in great shape. Our war management is in dismal shape. But we, even that, from a financial market standpoint, ultimately our economy is so good, AI is so good, the markets will handle it. The geopolitical mess will continue to cause some turbulence, but the financial markets will come out just fine, at least for the time being. We'll have to see how the 2028 election shapes up. That could actually change our outlook on the U.S. economy and the U.S. stock market, but we have a ways to go before we need to worry too much about that.